Hi, everybody. Let's look at depreciating an asset using the units of production method. This is considered an accelerated depreciation because it could give more depreciation up front than straight line depreciation, which we know gives the same amount each year. And it's logical to assume that it's an accelerated depreciation because, hey, we've got a new machine, it's efficient, let's use it. So let's wear that thing out. So using the same numbers we've used in our other calculations, we've got a cost basis of 12,700, an estimated salvage of 2,700, giving us a depreciable basis of $10,000. And we're going to use this machine with estimated useful life over 5 years. So again, whatever method we're using, we're going to depreciate it $10,000 worth over its useful life. In this case, let's say it's a manufacturing machine. We're going to say we have to estimate, we let our production people or the manufacturer or somebody has to give us an idea. Hey, with routine maintenance, how many units can this machine, how many widgets can it produce? And we're going to keep it simple. We're going to say that it's going to produce $20,000 units over the life of the machine, broken down by each year there. And again, we're making the assumption that we're going to wear this puppy out this because it's a new machine this first and second year. So we're going to use it a lot. One thing I do want to mention is that this can be used not only for units of production, but this is a function of use rather than just time. So it might not be units of production in the sense of the manufacturing capability. Maybe it's the units of production, how much time something is used. I've never depreciated an aircraft before. That's out of my league. But it's my understanding that rebuilding those aircraft engines are pretty expensive. So you may be depreciating aircraft engines depending on how many hours they got used this year. Or you might be depreciating a Caterpillar or other big tractor on the number of hours it was used this year. So if you've got something that's a significant cost and it's based and it's better to depreciate it rather than just the mere passage of time, but on its usage, I would certainly look at the units of production method for that. Okay, so like I said, to keep it simple, we've got $10,000 depreciable basis that we're going to depreciate this machine. We're estimating 20,000 units. So we're going to take that cost minus estimated salvage, that's the $10,000 depreciable basis there, divide it by the estimated units of production, which is 20,000, and we're going to get 50 cents per unit depreciation. And then we're going to multiply that by the annual production of this machine to get its annual depreciation expense. Okay, so we're going to see $10,000 divided by 20,000 units gives us 50 cents depreciation per unit. Every time this machine stamps out a widget or whatever we're producing, we're wearing that machine out 50 cents worth. And so year one production, we're estimating 8,000 units. So we're going to say, hey, that 50 cents times that 8,000 units, our annual depreciation expense is going to be $4,000 for the first year. So we put that into our depreciation journal entry. And after the first year, it's going to be what? Cost minus accumulated depreciation gives us our net book value. Okay. End of year two, what? We estimated we use this 4,000 units. Still a large number of units, but not as much as the first year. So we're going to say 4,000 units times 50 cents depreciation per production unit, and we're going to get $2,000 depreciation expense. Put that in our journal entry for the year. And so now at the end of year two, our accumulated depreciation is the 4,000 plus the 2,000, 6,000. So our balance sheet is going to show the machinery at cost of 12,700 minus 6,000 gives us a book value at the end of the year. Uh, I will mention, let's say you get to year five, say, and you use this thing up 2,500 units. Again, it depends on the company's policy, or if you're in class, the textbook that you're using. A lot of textbooks, if you're doing accounting class, a lot of textbooks will say stop depreciating it at the maximum life of 20,000 units. Just so you can, when you compare the methods of depreciation, we're comparing apples with apples. So just stop depreciating it. When you're in business, they may say, hey, we're wearing that thing out. You go ahead and just keep on depreciating it because maybe our salvage value isn't uh, as much now as we thought it was going to be because we've worn this thing out. So look at company policy or look at your class, what your textbook says. Like I said, a lot of textbooks will say stop at that $10,000 depreciable basis. Stop when you get there so that you can compare the methods year to year. But anyway, this is the units of production. And again, the most important thing to remember is we do set it up. We do look at the salvage and get the depreciable basis and divide it by the number of units we're going to produce total, and then use that figure to get us an amount per year. And so the main thing to remember that this is the depreciation method based not upon just merely the passage of time, but on the usage of the equipment, how much we're wearing it out each year. Units of production. Well, hope that helps, and we shall see you next time.